Good evening, everyone. Good morning, everyone. Welcome to the market analysis session brought to you by Oxshare. My name is Jimmy Jabbour, and we'll be going through the markets today to identify some points of interest and to set the pace for the upcoming week. First of all, let's start with the news. So this week we have some big news coming up. We've got on Monday, of course, we're going to start on Monday. So we have the new home sales for the um, USA. This is a big indicator of the healthy economy. Plus, the housing sector is plays a big role in the financial prosperity of the country. So it plays a big role in the economy of the USA. So we're gonna monitor these data when they come out. Plus, on Tuesday, tomorrow, we have the core durable goods orders. These are important data. Plus, we have the consumer confidence as well. Um, we jump to Wednesday. We have the GDP, the gross domestic product for the USA, and this is a big deal regarding how it will affect the market. Of course, the better the news, the higher the GDP, the better the news, the stronger the dollar, and yeah, we can say that if the GDP showed any a growth in these levels, the USA would have averted a hard landing or a recession. So a definition, a small tip, a recession is three quarterly decreasing GDP growth. So if the GDP growth here shows to be positive or increasing, depending on the last quarter, um, that we would have averted a recession in the USA. So this is a big news. We should monitor this. This is on Wednesday. Plus on Thursday we have also some big news. In Europe, we have the unemployment change in Germany, and we all know the case in the eurozone. It's been struggling due to the recession or bad data related to the economy of Germany, since it is the fuel for the eurozone. It's the main leader in manufacturing, so we should monitor the German data that's coming out this week, so we can have a better understanding for the um, eurozone and where it's headed. We have also the CPI for Germany, plus the core PCE for the United States, and that is a big an interesting data because the Fed relies mainly on the PCE as a measure for inflation. It excludes the energy and food prices. So this is very important. Plus we have the initial jobless claims, also a big data. Plus we have the Chicago PMI. Finally, on Friday, we have some interesting news. Of course, we have the CPI for the Eurozone, and that is important. This is the data that the ECB relies on to determine whether they need to maintain interest rates or start thinking about cutting them. So it is very important to monitor the CPI for the Eurozone. Plus, we have the global manufacturing PMI for the US, ISM manufacturing PMI, and manufacturing prices. And we have the FOMC daily speaks. We could see some volatility during his speech, but it comes at after hours around 8:30 Beirut time. So yes, these are the main news coming out this week. So all traders should monitor these news, adapt, and then exercise caution and risk management. So let's jump into the charts. So as usual, we're gonna start with the high time frames and then jump back to lower time frames. We're starting off with the DXY. So let's see the daily. So in a previous In a previous analysis around 2 months ago, we said that liquidity levels around these points are crucial. We might see a drawdown. We're taking out this liquidity as we did here. So we raided these stops, and then we expected a move to the upside. And we said that a price is attracted to this gap over here, and we might see price pushing up and then retreating back, depending as well on the way the Fed sees fit to move forward, either by maintaining high interest rates or start cutting them in the upcoming month. So if we want to take the midpoint of this fair value gap, we can see price respected this fair value gap here. We tipped, we touched it, and then we pushed to the downside exactly as we said it would have done. So it is very important to keep an eye on the XY, as it can show prospective movement for other pairs like Euro USD and GBP USD. So as we said before, just a small recap, these are liquidity levels over here. We expected a raid. We didn't know exactly how much the raid would go, but we knew that in this move downward, we had to take out these liquidity levels over here, and then we expected a push to the upside before continuing the move to the downside. And we want to see where the price would be attracted to, and we saw this big candle over here with the gap, and this candle formed a gap. So we pushed up, pushed to the midpoint. We call it encroachment over here. So we pushed to the midpoint, and then we rejected downward. Now, if I want to move to a lower time frames, so we can see that we broke structure over here. So we broke structure to the upside over here, and then we had this block, this order block over here that got respected to the point. So we touched it, and then we pushed up. This could have been a good scalping opportunity. Of course, we wait for the price to retreat. So we had a push. We waited for the price to retreat, and we could have taken a small uh, scalp trade over here. So uh, we always base our analysis on high time frames, and then we set our point of interests on high time frames like we did over here. So we have this order block on high time frame on the 4 hour. Then we can go down in time frames and check out how the reaction happens. So this is the 15-minute. So this point over here, we had the push to the order block, and then we pushed to the upside. To summarize a bit about the DXY, so we had this good order block, 4 hour order block over here. We saw this reaction. There is a volume imbalance over here as well. So you see this gap. We might be forming some internal liquidity points here. So we might push down, take this liquidity, fill this gap over here, maybe push up a bit, and then target the low hanging fruit or the low over here. So this is very important. Keep this in mind. We'll jump to the Euro USD. So here we had this break of structure over here. So we accumulated a bit at these points. See the accumulation over here. Then we broke out, breaking structure, changing character. So we were falling. We were forming lower lows, lower highs. Then we started to accumulate a bit. Then we broke structure to the upside, leaving this order block over here. this last red candle before pushing up to the upside. And as you can see, we had liquidity levels over here. See these equal lows here and here, here and here. Yes, so these equal lows got traded. We took out these equal lows, pushed down, took the liquidity, respected this order block, then pushed to the upside. So we have the euro forming higher highs. Then we took this. This was a trap. So everyone who longed at these support levels over here, they got stopped out, and then the real move happened. So it's very important to identify liquidity levels so we can anticipate where the price would go and follow our rules and risk management, of course. So this was a good swing trade over here. Entry at the top, stop loss at the low, target first target at this high, and then we can target first target here. Second target should be this high, and just let your winners run. So this is related to the Euro USD. So we're gonna go to the gold. So same thing for gold. We had on the daily, we had this low taken out, and everybody started shorting gold. So thinking we broke structure over here, we turned bearish. We are forming lower highs. So everyone shorted at these points. Of course, the real point of interest that we need to break is this low at 1975. So as long as we stay above this this low over here at this point, yes, so the better the move is still to the upside. Once we break this low, we can start to target these lows and these gaps over here. So if we want to take the fork from here, so this is the midpoint. As you can see, we try to break and then close below. This is one standard deviation from the median, so we respected this as a support. Once we broke down, it acted like a resistance, and then we pushed down, but still the move is still to the upside. So any break below this level would signal that we are maybe shifting short-term trend for the gold. Of course, it is very dependent of the data that's coming out this week, plus the conflict in the Middle East. So if things move in a solution to a solution, maybe if it's temporary, it doesn't matter. So if there is a solution in the horizon, we can expect gold to have a corrective wave depending on this move. So it's also geopolitically dependent and data dependent. So we're gonna move to the 4-hour. So we have these liquidity levels forming over here, and we have the final target around 265 over there. So we see the gold violated this gap. So it did not respect this gap. So we pushed up, and then we didn't have a rejection. We pushed to the upside. So here, this is an inverse rally gap, so we can use it for long positions. And when we go in time frames, lower in time frames, you will see it better. So we'll check the 15 minutes. So if you wanna, uh, so we had these lows over here got taken out. We left this huge gap, but gold did not respect this gap. So as you can see, we directly pushed to the upside and we broke this gap. So this gap now is a point of interest, but too long, not too short. So once we broke out of this gap and we broke this high over here, signaling a change in character. So we went from forming lower lows, lower highs to forming higher highs. So this gap should act as a support. So one possible trade would have been longing at this gap, stop loss just below it, and then targeting these points over here. It's a nice 1 to 4 trade. Of course, risk management is very important at these points. So now we see gold. So we set our high time frame targets at 240, 242, 244. So we see gold push to the upside, and then at this point over here, respected this gap, as you can see here. So we respected this gap. Now, this could be initial Elliott wave move. So this is wave 1, retracement wave 2, pushed back again wave 3, retracement wave 4, and then we could push up at these point at 2041 here. And this is would be wave 5 equal to wave 3, or we can have an extended wave 5. That means we can push beyond wave 3, or we can have crunched wave 5. That means the wave 5 created would not take the levels of wave 3. This could happen in Elliott counts. So we will see, as long as we are respecting these levels, this fair value gap over here, and respecting this order block over here, we can still have liquidity forming at these points. So we might see gold moving in this direction and then push down, liquidate them, and then the real moves occur like usual. So it's very important to monitor gold now, see if it will respect these levels or form some type of internal liquidity over here, push back up, liquidate these stops over here, then push down, liquidating the longs, and then we push to the upside. So this is related to gold. We'll jump to the US 30, which is making higher highs and historical highs, as you can see over here. So we've been talking about the indices for quite some time now. About 2 months ago, so we said that it is unlikely we will see a great correction at this time, and this was fueled by many reasons. One of them that we had end year financial reporting for companies, and these companies, especially firms that are related in investment, these firms had an idea or had a perception that the economy uh, is not very well. We might see some aggressive selling, and they maintained cash for their investors. They maintained the investors' cash, not investing them, waiting for a correction to happen. And then the end of year happened, and they needed to report their financial earnings for these investors. So they started buying, as you can see here, December. So this is December. This is December 1. Okay, so you can see the aggressive buying that happened here, and then we continued, fueled by good economic and financial reporting from the Magnificent Seven. That means Nvidia, Tesla, Facebook, Meta, and many more, Amazon, Google. So these moves were fueled by good financial reporting by these companies. So to analyze a bit the US 30, of course, we've been on an amazing push to the upside since October, and we started to lose some momentum over here. Of course, good economic data would fuel a push to the upside even more. If we want to check, the possible corrections for this amazing wave, uh, the 0.382 is a likely level, as we might not see a correction lower than 50%. So of course, this is all data dependent, and really it isn't the trader's job to pick highs and to pick lows. So his job is to adapt to the markets, take what opportunities the market is giving, and then exercise some good risk to reward and some good risk management techniques. Okay, so yes, exactly. So this point over here, this is the low, the high, and the other low. We formed this pitchfork. So as you can see, we are respecting the two standard deviation of this pitchfork. That means this point over here, it's very important to uh, monitor these levels. We can see a pattern over here forming. We might see a push at this level, and even at this level before. These harmonic moves happen all the time. This is the bat. Uh, this is the bat move. So as you can see, it's forming a bat over here. So we might see a bit of extension at this point, and then we push down. First target would be at B, and second target would be at C. So yes, it's very important to keep an eye. Plus, in our weekly analysis and our daily analysis, we gave out these levels by forming the Fibonacci extension. So we said we might see an extension wave of 1-to-1 at this point over here. Of course, we had a bit of push above that, but then got back into it very quickly. So these indices are very cyclical, meaning they are very sensitive to economic data. Uh, Plus, they are very sensitive to the financial reporting of the companies that form these indices. So as you can see in the Nasdaq, because uh, it shows the 100 biggest companies in tech by market cap, of course. So once Nvidia earnings beat the expected, and the stock price rose by 12% last week. So we saw this monster move on the Nasdaq, because the Nasdaq is mainly the 100 companies, but what moves it are the Magnificent Seven, and these are Tesla, Apple, Google, Microsoft, Amazon, Nvidia, and Meta. So these stocks form the big chunk of the Nasdaq. Good earnings for these stocks will push the Nasdaq to the upside. Uh, this was it for today. Thank you for tuning in, and trade safe, everyone.